The sell-off in gold and silver caught many investors off guard. Prices moved sharply after a sudden shift in policy expectations. Retail positioning was built for stability, not shock. The speed of the move revealed hidden fragility. Precious metals often fall when certainty briefly returns. A single signal can reverse weeks of defensive positioning. When fear pauses, protection unwinds quickly. Gold and silver absorb that unwind immediately. The Fed shock was less about action and more about tone. Language changed expectations in minutes. Markets repriced future paths rapidly. Metals responded to the change in narrative. Retail investors tend to anchor to recent trends. Rising prices reinforce confidence in protection trades. When conditions flip, exits become crowded. Crowded exits amplify downside. Silver reacts more violently because of its dual identity. It trades as both a metal and an industrial input. That tension increases volatility during macro shifts. Volatility accelerates emotional responses. Gold's decline reflected positioning, not rejection. Protective allocations were reduced temporarily. Reduction does not equal abandonment. It signals reassessment under new assumptions. Bond yields played a quiet but critical role. Yield movement alters opportunity cost perceptions. Higher perceived yields pressure non-yielding assets. Gold and silver feel that pressure first. The crash looked sudden, but pressure was building underneath. Leverage accumulates during calm periods. Calm hides imbalance. Shocks expose it instantly. Retail sentiment lagged institutional adjustment. Institutions repositioned faster using macro signals. Retail relied on price confirmation. By then, momentum had shifted. This episode highlights how fast narratives can reverse. Markets move on expectation, not explanation. Explanation arrives after prices adjust. Retail often reacts last. The Fed shock temporarily reduced the demand for immediate hedges. Markets interpreted the signal as reduced near-term risk. Reduced risk perception weakens defensive trades. Gold and silver respond quickly to that shift. Retail investors often assume policy changes work gradually. In reality, expectations change instantly. Prices move before fundamentals adjust. Precious metals reflect expectations first. Silver's crash revealed how speculative positioning had grown. Short-term traders chased momentum aggressively. Momentum reversals punish late entries. Silver magnifies that punishment. Gold's decline appeared orderly compared to silver's volatility. Orderly declines still represent meaningful repositioning. Institutions trimmed exposure methodically.
Retail
Saw only the price drop. Futures markets amplified the move through forced liquidation. Margin pressure accelerates exits. Exits feed additional selling. Selling becomes self-reinforcing. The shock exposed how crowded the metals trade had become. Crowding builds quietly during uncertainty. Confidence grows without challenge. One signal breaks the balance. Retail narratives focused on long-term inflation protection. Short-term positioning ignored tactical risk. Tactical risk dominates during shocks. Gold and silver reflect tactical flows. Bond market reactions validated the metals' sell-off. Yield shifts altered relative attractiveness. Relative changes matter more than absolute levels. Metals adjust to relative changes rapidly. Currency strength also contributed to pressure. A firmer currency reduces metal appeal temporarily. Temporary shifts still move prices sharply. Retail often underestimates currency impact. This phase was not a structural breakdown, it was a reset of expectations. Resets feel violent when positioning is one-sided. Precious metals absorb resets efficiently. The speed of the decline exposed how positioning had replaced conviction. Many holders expected metals to act as static protection. Static assumptions failed during expectation shifts. Gold and silver trade dynamically, not defensively. Fed communication often matters more than policy action itself. Markets trade the future path, not the present stance. When the path shifts, positioning adjusts immediately. Precious metals are highly sensitive to path changes. Retail traders underestimated how quickly fear can pause. Fear rarely moves in straight lines. It surges, stabilizes, then retreats temporarily. Metals react to each phase distinctly. Silver's deeper drop reflected thinner liquidity. Liquidity disappears fastest during reversals. Thin markets exaggerate price moves. Retail feels the impact most. Gold ETF flows revealed quiet institutional selling. Selling was controlled, not panicked. Control signals rebalancing rather than exit. Retail often misreads controlled selling. The crash forced traders to confront time horizon mismatch. Long-term beliefs clashed with short-term leverage. Leverage demands immediacy. Metals punish leverage during shocks. Volatility spikes create forced behavior. Margin calls remove discretion. Discretionless selling accelerates declines. Gold and silver experience this repeatedly. Narratives lag price action during sudden moves. Explanations appear after damage is done. Retail waits for clarity. Markets do not wait. The Fed shock also reset inflation expectations marginally. Even small expectation changes matter. Metals price marginal shifts aggressively. Margins drive momentum. Phase reflected mechanical unwinding, not loss of relevance. Unwinding feels final while it happens. History shows it is cyclical. Metals move in waves, not straight lines. Retail investors often underestimate how positioning drives short-term price action. Beliefs feel permanent, but positioning is temporary. Temporary positioning unwinds quickly under pressure. Gold and silver reveal that reality brutally. The Fed shock reduced urgency around immediate inflation hedging. Urgency fades faster than narratives change. When urgency drops, protection trades unwind. Metals respond before stories adjust. Silver's industrial exposure amplified selling pressure. Slower growth expectations reduce industrial demand assumptions. Assumptions shift before data confirms them. Silver prices react to assumption shifts. Gold's role as insurance does not prevent drawdowns. Insurance pricing fluctuates with perceived risk. When risk feels lower, premiums fall. Gold reprices its insurance value dynamically. Institutional traders adjust exposure incrementally across multiple markets. Metals are one adjustment lever among many. Coordinated adjustments compound effects. Retail sees only the result. Derivatives markets accelerate trend changes. Options hedging forces futures selling. Futures selling pressures spot prices. Complexity magnifies volatility during shocks. The crash highlighted how leverage concentrates risk in calm markets. Calm invites confidence. Confidence invites leverage. Leverage collapses fastest when assumptions break. Retail panic often begins after forced selling ends. Prices stabilize briefly. Emotional responses follow stabilization. Timing disadvantages, retail participation. Metals recoveries usually start quietly after resets. Volume dries up before price stabilizes. Stability rebuilds confidence slowly. Retail often misses early recovery phases. This stage separates conviction from expectation. Conviction adapts slowly. Expectations change instantly. Markets reward expectation awareness. Short-term metal crashes often occur when protection feels temporarily unnecessary. Markets oscillate between fear and relief. Relief unwinds hedges faster than fear builds them. Gold and silver reflect that asymmetry clearly. Retail investors tend to interpret declines as failure of the thesis. Institutions see declines as repositioning. The difference lies in time horizon. Time horizon determines emotional response. Fed credibility shocks do not remove uncertainty, they redistribute it. Risk shifts across assets rather than disappearing. Metals lose demand briefly as other assets absorb it. Redistribution creates volatility. Silver's speculative crowd exits more aggressively during shocks. Speculators require momentum confirmation. When momentum breaks, exits cascade. Cascades intensify price damage. Gold's relative resilience compared to silver matters. Signals selective unwinding, not total abandonment. Selective behavior reflects discipline. Discipline stabilizes long-term structure. Currency reactions magnify precious metal moves. Stronger currency expectations reduce metal appeal temporarily. Temporary shifts still cause sharp repricing. Retail underestimates currency sensitivity. Inflation narratives rarely resolve cleanly. They pause, resume, and mutate. Metals price the pause aggressively. Resumption happens later. Bondmarket.com can mislead retail observers. Calm does not equal confidence. Calm often masks positioning shifts. Metals detect those shifts early. Crash phases usually complete faster than accumulation phases. Selling compresses time, buying stretches it. Retail reacts to speed, not structure. This phase tested patience rather than conviction. Patience feels hardest during uncertainty. Uncertainty amplifies discomfort. Markets reward those who recognize cycles. Gold and silver often bottom when attention shifts away from them. Silence replaces debate after violent moves. Silence allows positioning to reset quietly. Resets create conditions for stabilization. Retail investors frequently wait for confirmation that never arrives. Confirmation usually appears after prices move. Waiting feels safer, but costs opportunity. Metals recover before consensus returns. Fed shocks compress decision timelines across markets. Compression favors liquid assets first. Precious metals absorb rapid adjustments. Speed amplifies price swings. Silver's volatility discourages weak hands quickly. Weak hands exit under pressure. Stronger holders remain after exits. Remaining holders stabilize prices. Gold's role shifts from trade to allocation after resets. Allocations move slower than trades. Slower movement reduces volatility. Reduced volatility signals transition. Institutional re-entry often occurs gradually. Small purchases replace large exits. Gradual buying avoids headlines. Retail rarely notices accumulation phases. Narratives rebuild after price stabilization, not before. Stability restores confidence incrementally. Confidence invites selective inflows. Metals respond quietly. The relationship between rates and metals remains nonlinear. Direction matters less than surprise. Surprises drive repricing. Gold reflects surprise sensitivity. Fear trades unwind faster than they build. Protection sells quickly during relief. Relief never feels permanent. Metals oscillate accordingly. Stage rewards observation over reaction. Reaction locks in losses. Observation preserves flexibility. The markets favor flexible positioning. Market memory fades faster than structural conditions change. Recent pain dominates perception. Structural forces continue quietly beneath sentiment. Metals respond to structure before memory resets. Retail investors often confuse volatility with failure. Volatility reflects adjustment, not conclusion. Adjustments are necessary during regime shifts. Gold and silver price regime shifts continuously. Fed communication shocks highlight how dependent markets are on narrative framing. Framing alters expectations immediately. Immediate changes move positioning. Metals react without hesitation. Silver's role as a speculative instrument increases emotional swings. Emotion drives short-term extremes. Extremes exhaust sellers eventually. Exhaustion precedes stabilization. Gold's correlation with risk assets fluctuates during shocks. Correlation rises temporarily, then falls. Falling correlation restores diversification value. Restoration supports renewed demand. Institutional risk models recalibrate after sharp moves. Recalibration reduces exposure incrementally. Incremental reduction prevents panic. Metals stabilize during recalibration. The absence of new negative catalysts often matters more than positive news. Stability allows repricing to settle. Reduced volatility invites cautious re-entry. Retail sentiment usually bottoms after price damage is done. Emotional capitulation follows mechanical selling. By then, risk has shifted. Metals begin transitioning. Crash narratives simplify complex positioning dynamics. Simplicity comforts stressed investors. Comfort rarely matches reality. Reality unfolds more gradually. This phase tests discipline more than insight. Insight exists before comfort. Comfort arrives after price adjustment. Markets reward early clarity. Gold and silver crashes often complete before retail understanding catches up. Prices adjust faster than narratives evolve. By the time explanations feel clear, positioning has already shifted. Metals move ahead of collective realization. Retail investors expect protection assets to move smoothly. Reality is more uneven. Protection reprices aggressively when fear pauses. That repricing feels like betrayal to late participants. Fed-driven shocks remind markets that expectations dominate fundamentals short-term. Fundamentals change slowly. Expectations change instantly. Precious metals trade expectations first. Silver's sharper declines highlight its sensitivity to macro mood shifts. Mood swings matter more than data releases. Emotional positioning amplifies moves. Retail experiences the extremes. This episode reinforces a recurring pattern in markets. Shock leads to reset. Reset leads to stabilization. Stabilization quietly rebuilds the next phase.